That is the closing bell on Wall Street, and now it's Market Domination Overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us here to break it all down. Jared, let's get with you on that close.
You, Josh. I'm looking at a photo finish for the S&P 500. Assuming this holds, and this is correct, sometimes these things fluctuate, that would be another record high for the benchmark index of the world. But the Dow really claiming the top spot in the majors today, up 0.5% or 238 points. That is another record for the Dow. NASDAQ slid a little bit today. You can see it spent about half of the afternoon or half of the day in the red there, but off of those lows. And then the Russell 2000, that is a record close for the small cap index as well. And speaking of records, you can add utilities to that. Utilities had a fine week, up 2.5%, only eclipsed by healthcare, which is number 2 today, but by far the biggest winner this week, up almost 7%, the best week in a few years there. Also doing well today, financials, energy, but to the downside, you're going to see the 3 mega cap sectors are the only ones in the red, the only ones underperforming the S&P 500 there. So let's take a peek at the NASDAQ 100. And there you can see Meta leading the big guys down by about 2.25 percentage points. Tesla also down about 1.5%. Palantir down 7, KLAC down about 3, and Mercado Libre down about 3% as well. But we did have, as I was pointing out earlier, there's actually, well, we'll call this a split board. It was more green than red in the last hour. But the Dow definitely looking at some solid gains today, a lot more green on this board. Visa, J&J, Goldman Sachs, Caterpillar, United Health, Travelers, all up more than 1%. Nike, the leader to the downside, down about 3.5%, although over this week, down up about 3.8%. And then taking a look at some of the leaders here, oil and Bitcoin and regional banks. Regional banks had a tough week last week, but not this week. Biotech, part of that healthcare trade, screaming higher this week. And small caps, those did well. And we can also take a look at the crypto board. I'll just give you a sneak peek of that. We're going to cover that more in depth in about 30 minutes, Josh. But here's Bitcoin up 1.5% to 122,736.
All right, thank you, Jared. Well, the major indices have been notching new record closes, shrugging off that government shutdown. According to our next guest, history shows what is felt on Main Street versus Wall Street. For more on what may be ahead for markets, let's get to CFRA Research Chief Investment Strategist. That would be Sam Stovall. Sam, always great to see you. So here's what you're telling clients, Sam. You put it like this. You say, history reminds us that government shutdowns have typically been more headline making than bottom line impacting. Walk us through that, Sam. What do you mean by that?
Sure, Josh. Good to talk to you again. Well, what it really means is that the market, might sort of hold its breath during the first couple of days of a government shutdown. But let's face it, in the typically average 8-day shutdown, the market has actually risen in that time period and has posted a positive batting average, meaning it's gained more days than it's lost. And if you go back to 1984, because we had been seeing shutdowns for about 10 years prior, investors started to say, okay, tell me something I don't know. And from that point forward, the market was up more than 70% of the time during the shutdown, and then was higher more than 90% of the time in the 30 days after the shutdown. So basically, shutdowns have been non-events for the market, but they've been great things to talk about in the financial media.
Let me ask you something. There are economists who suggest, and I want to run this by you, they'll say, well, what if this shutdown lasts longer than we expect? What if it lasts longer than just even a few weeks, and then the Fed doesn't have that hard data they want and expect, and maybe the Fed then, maybe they don't cut it at that next meeting, Sam? One, what do you just make of that hypothetical? And two, if that happens, Sam, how would you expect the markets to respond, to react?
Well, first off, back in 2018, 2019, we had a 35-day government shutdown. And in that 35-day period, the market was up 10.5%. And then it was up another 5% 30 days later. So if you really were going to be saying, well, gee, if this ends up being a drawn out affair, well, let's go right back to 2018, again, under a Trump administration, and the market did just fine. So, I would tend to say that history would refute the worries that investors have at this point. I also think that because the Fed cut at the most recent meeting in mid-September, and because the data had been looking soft, I think the Fed would err on the side of caution by cutting again in October and then say, the government should be reopened by the time we have our December FOMC meeting. So if the data looks a little hotter than we thought, well, then maybe we'll hold off on another cut in December. But I think essentially investors are focusing on the 4 E's. Enthusiasm surrounding AI, the expectations for at least one more cut by the Fed this year, emotions. We can see it in the term of FOMO, or fear of missing out. And then lastly, earnings outlook for Q3, which right now is expected to show a 7% gain.
I was going to get to that, Sam, because listen, that earnings season is going to be here before you know it. What are your earnings expectations, Sam? What do you want to see and hear from those CEOs and CFOs?
Well, everybody wants to hear good expectations. And I think management has always done a very good job of managing expectations, because we have seen 64 of the last 66 quarters post actual results that exceeded end of quarter estimates. Right now, the expectation is for about a 7% year-on-year gain in Q3 for the S&P 500. We're looking for 6 of the 11 sectors to post advances. The biggest gain is likely to be technology, with a 21% year-on-year rise, and then followed by strength in industrials, and also looking at good results for the communication services category. So financials as well should post strong earnings. So I would tend to say that even though the bar is a little bit higher than where it was when we started reporting the Q2 earnings, that there's a good likelihood that this quarter will see beats as well.
What about overall valuation, Sam? I realize, listen, it's not a market timing tool, but even Jay Powell sort of suggesting we're stretched here at these levels.
Well, you could say that, is that 2000, gosh, it's so long ago, 1996 all over again, when Alan Greenspan talked about irrational exuberance. So maybe we are early in the game, but you're absolutely right. If you look at a 20-year history for the S&P 500 valuations, we are trading at a 42% premium and a 63% premium for the technology sector. If you look to a 5-year average, however, which some tech analysts are talking about, because that's really as long as AI has been around moving the market, we're still looking at a 16% premium for the S&P and then an 18% premium for technology. So I would tend to say, yes, valuations are elevated, but I think that the momentum is such that this market will carry forward to new highs as we proceed in the next couple of months. And then I would say worry about digestion early in 2026.
I want to end here, Sam, just bottom line. On a sector level, walk me through it where you see opportunity. Where do I want to be overweight?
I think you want to be focusing on the momentum areas still, because we have 3 months to go, and I think a lot of professionals are behind their benchmarks, and so they want to not only earn their bonuses but also keep their jobs. So I would say technology, certainly, because they're expected to post a higher earnings increase for this quarter, communication services, and financials, and then to a lesser extent looking at the industrials, where we've seen today a little bit of a pop in those also-rans, meaning energy, healthcare, staples, but I still think it's the momentum play that will carry us through.
Sam, always great to see you. Enjoy that weekend.
Thanks. You too, Josh.
Well, the government shutdown delaying the September jobs report, meaning a lack of official data, triggering a search for private data sources. Yahoo Finance spoke with MacroX Studio founder and CEO who's aiming to provide that data.
We started MacroX thinking we can count faster than the government by using satellite data, social data, credit card data, foot traffic, essentially combining all these different data to provide this 360 view. What we didn't realize is the government would stop counting.
This is a day normally that we would be talking about the Bureau of Labor Statistics, the government jobs report. What kinds of things are you looking at, and what are you seeing in your jobs data?
So we specifically for job market, we look at things such as social media. We look at how anxious workers are. If they're looking for food stamps, are they really worried about job cuts? Are they tracking layoffs? What's going on there? We look at those. And then we also look at kind of what is the bargaining power of employers? Are they complaining about, oh, I have to pay my workers a huge bonus to retain them, which was the case about 3 years ago, no longer the case? Or are they concerned about they do not have enough kind of worker supply because of the immigration crackdown? So we track all those things and we crunch them all together to essentially show that some of the concerns raised actually by the previous guest. So Torsten's a hero of mine. So there are natural concerns about wage growth. So we can tell him the white line, by the way, is the government data that lags kind of our data by 2 to 3 months. So what we can see here is the wage growth is indeed neutral. It is not ticking up, but it's not going down. So essentially the labor market is in this uneasy equilibrium where there's low supply and low demand. The unemployment rate is ticking up, is slowly cooling. So unemployment rate over the last few months ticked up. This month, we do not see unemployment rate ticking up. So we estimate the unemployment rate to be 4.28%, which is close to what it was before. So yeah, there's no major weakness. We do see one interesting point I'll make that our data enables us to see is that the overall economy is stronger than the non-farm payrolls, especially the jobs report, especially last month. When the jobs report came out weaker, the market the bond market, rallied. In other words, the market kind of plummeted, the yields plummeted. So what we can tell you is that the growth rate, the GDP growth rate is close to 3%, which is different than kind of a 50K or so payrolls. So the two have diverged distinctly in part because payrolls are quite noisy and the noise has become really high with two kind of revisions. The people don't respond to surveys, but then there's these annual revisions done by census.
Right.
So those two have resulted in payrolls becoming super noisy. And we want to say that alternative data tells us that's not the case. The economy is okay, although the hiring is weak.
And I'm curious in particular if you have a read on what's happening with entry-level workers, because I'm hearing anecdotally from some executives, let's say I brought in an analyst class or an entry-level class on the professional level of 10 people a year. This year, maybe I'm doing 5. Next year, maybe I only need to do 2 because those workers I'm bringing in are more productive because they're using AI. Are you measuring that, and is that something that is playing out, or has that been overstated?
That's a great question. So what we do see that CEO hiring intentions, so we track when CEOs talk about, hey, are we going to hire or not, wherever they are, so whether it's an article or print. So we see the hiring intentions fortunately ticking up a little bit from the very low levels, but it is still distinctly below trend. So we would like to see more hiring.
And then what about on the inflation side, which is the other big equation? We don't know if we'll get CPI in a few weeks, right? We don't know if the government will still be shut down. But I imagine you can do quite a lot of survey data on your own in terms
Correct.
of what's happening with prices.
Yes, so we have our inflation drivers. So the two large categories, kind of goods and services. So we are able to look at services depend in large part on worker kind of bargaining power versus employer bargaining power, right? So that's the wage setting. If there's not enough immigrants, do you need to raise wages to essentially get enough workers in? So thus far, we're not seeing signs of that much. So we see it as flat to neutral. We are not seeing services inflation rising over the next 2 to 3 months, which we know is a little bit contrarian view, but that's what our data is showing. We are all, in terms of goods prices, we do see a little bit of a tick up. So that's the alternative measures of good prices. We see them tick up a little bit, but we're not seeing this massive acceleration that was feared. So we kind of see like a 8 to 10 basis points rise kind of spread out over the year, and we see that continued pace, but we don't see this massive uptick in goods either. So thus far, we are in the soft landing camp.
Coming up, America's heartland may be hurting from tariffs. Will a possible plan to bail out farmers go far enough to help? We're speaking directly with a soybean and corn farmer when we return. Stick with us. The Trump administration may roll out what it calls substantial support for American farmers who have suffered losses due to trade policy. Now let's hear directly from the farm. Blake Hurst joins us. He is former president of the Missouri Farm Bureau and a farmer. Blake, welcome to the show. I want to start off kind of bigger picture, Blake, because I'm curious to hear how the American farm economy is doing right now, Blake. You know, broadly, how is it holding up? What is your sense?
Well, we're overall farm income is down slightly, but that's a tale of two different economies. Livestock, particularly cattle, are doing very well. Crop farmers like our farm are operating at a loss.
Why are you operating at a loss, Blake?
Because our prices 3 years ago for the bushel of corn was $7. Today it's $4. Our costs have remained the same. Same percentage drop for soybeans, or probably a little worse. So we've seen a tremendous drop in our profitability.
And Blake, my understanding is that in particular, it is the soybean farmers like yourself who are having a particularly challenging time. Is that accurate?
Oh, absolutely. Over the past few years, China has purchased 25% of U.S. soybeans. This marketing year, which starts in the fall, on October 1st, they have contracted for zero. So we basically, by a typical year, 10% of our crop would have been marketed to Chinese buyers. This year, we've sold zero. So that's obviously weighing on prices and makes a real concern about how we're going to even have room for this year's soybean crop. It's a good crop. In much of the Midwest, we had a very favorable summer, but we're faced with low prices this fall.
So put some math on this for me, Blake. You will sell your bean crop for about what a bushel, you think?
Well, today, right around $10, and that's just barely break even on soybeans. Again, 2 or 3 years ago was $13 or $14 a bushel. So farming is cyclical, and this isn't our first rodeo with a drop in prices. But it has definitely been made worse by the trade war with China.
Let me ask you, Blake, if President Trump can cut some type of deal with Xi and get the Chinese to buy U.S. soybeans, what would that mean for your farm and for the industry?
Oh, it would be a tremendous boon to the industry if we got a deal. Of course, if we hadn't put our tariffs on in the first place, we wouldn't have needed a deal. We would have been operating in the normal market economy, but that's not the route we decided to take, and farmers are paying the price.
Well, here's, Blake, maybe, the Trump administration, I'm guessing, might put it something like this. They might say, Blake, what we're trying to do it's big, it's historic. We're trying to reform the global trading system, and there's going to be some short-term pain, but longer term, the objective is to put American industry and American farmers on firmer, fairer ground with stronger trade deals. What do you say to that?
Well, we put the first round of tariffs on China in 2018 during the first Trump administration. The Biden administration kept them in place. We've had 7 years to see how this experiment's going to work out, and so far it's a complete bust. There's no other way to put it. We have seen the administration announce a couple trade deals. The most recent one with Taiwan, and they said, by golly, we're going to sell Taiwan $10 billion of agricultural goods in the next 4 years. The problem is, in the last 4 years, they've bought over $12 billion. So the deal that they're trumpeting is no better than the status quo. So far we have not seen those results. So far we have not seen an improvement in our position as exporters.
Let me ask you, Blake, the Journal is reporting here that Trump is considering $10 billion or more even in aid to farmers. What would you make of that possible response?
Well, if he sends me a check, I will spend it. But it seemed rather, it's crazy when you think about it. We put on tariffs, collect money, and then we take that money, which we've collected from American consumers, including farmers who buy imported goods. We take that money and give it to the industry that's been hurt by those very same tariffs. Seems to me that it would make a lot more sense to get rid of the middleman, drop the tariffs, and again, resume normal trade relations.
Let me ask you, Blake, what is your sense of how much farmers in the farming community still support Trump, despite, financial challenges?
The most recent polling I saw said 70% of farmers support our present trade.
Why is that,
policy.
Blake? Why is that, Blake?
That's a very good question. It's because I think we're conservative. We like a lot of the things that President Trump has done in other areas. We're willing to give him a chance, but time is not on our side, and it's certainly not on the side of the Trump trade policy.
Final question, Blake. I am curious. Trump's deportation policies. What kind of impact? What kind of effect is that having on the American farming economy? What do you hear?
Well, that's the difference of what kind of farming. I'm sitting in a combine today, turned it off for a minute to visit with you. So we use a lot of machinery, and we're able to do most of our farm jobs with machinery. And so we don't depend on migrant or temporary labor. As it turns out, we have a greenhouse business, and we do use H-2A labor. They're legal, but we do use workers from Mexico. So I've seen both sides of the story, and for those farmers that have a lot of apples to pick or strawberries or any other crop that's picked by hand, the deportations are a real concern, I'm afraid.
Blake, it's great to have you on the show today. Thank you for your time, sir.
You bet. Thank you.
It's time now for What to Watch. On the earnings front, investors can expect to hear quarterly results from Constellation Brands, Scott McCormick, PepsiCo, Delta Airlines, the latest results to shed light on the state of the consumer amid growing pessimism, particularly about their own financial prospects. Sticking with the consumer, the University of Michigan is set to release preliminary October data on consumer sentiment. The index easing about 5% in September, but remained above the low readings seen in April and May of this year. Economists expecting sentiment to tick slightly lower in October. The latest report coming as consumers continue to express frustration over the persistence of high prices. And moving on to the Fed, investors can expect to hear from a slew of Federal Reserve officials, including the Fed's Raphael Bostic, Stephen Myron, Neil Kashkari, Michael Barr, Michelle Bowman, and Jerome Powell. Markets to keep an ear out for remarks regarding how the central bank is looking at monetary policy ahead of the FOMC meeting on October 28th and 29th. And turning to Washington, the Senate failed once again to pass the Republican and Democratic short-term spending bills. As a result, the government remains in shutdown mode. On Monday, the Senate chamber is expected to return and once again try to advance GOP and Democratic funding proposals. And lastly, OPEC Plus is meeting on October 5th. Nations are looking to reach a consensus on how to adjust their oil production next month. Traders speculating OPEC Plus will consider raising output more than originally anticipated. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I got you covered for the next half hour with the latest and greatest market room stories. Stay tuned.